In April 2026, a failing company added 2 letters to its name and watched its stock violently spike 600% in a single day. That company was Allbirds. You probably know them for making sustainable wool sneakers. By early 2026, they had lost more than 99% of their peak $4 billion valuation, and their physical retail empire was collapsing. So they sold off their entire shoe intellectual property for $39 million. In its place, they announced the birth of NewBird AI, a pivot to leasing high-performance computer chips as a cloud service provider. Welcome to the Wealth Code. Hit subscribe because today we are tearing apart the math behind the AI hype machine. Watching a dying shoe brand try to lease cloud servers looks exactly like the year 2000, when companies were slapping a .com onto their names to instantly manufacture millions in stock value. Retail traders piled into this pivot, buying the narrative of easy tech money while ignoring the astronomical costs required to build artificial intelligence. Let's audit this pivot. To fund their new network, NewBird AI secured a $50 million financing facility to purchase graphics processing units, or GPUs. A single NVIDIA H100 chip costs $40,000. Building a generative AI cluster requires linking tens of thousands of them together. True data infrastructure costs billions. NewBird's $50 million budget buys one server rack, while competitors build entire server cities. Yet, across the market, speculative AI startups are currently carrying valuations of hundreds of millions of dollars per employee, despite generating zero profit. In heavy AI infrastructure, a $50 million investment disappears as a mathematical rounding error, destined to be crushed by the sheer weight of industrial scale. We've seen this exact cycle before. In 1849, thousands of prospectors flooded into the muddy, developing streets of San Francisco to dig for gold. And waiting for them was a man named Samuel Brannan. While desperate men risked their lives and their life savings in the dirt, Brannan refused to mine. Instead, he recognized a geographic bottleneck and opened the only supply store in the area. This chart compares the daily take of an average 1849 gold prospector against Samuel Brannan's store revenue. While most miners found absolutely nothing, Brannan was generating the modern equivalent of $120,000 a day just by selling them basic supplies. The structural lesson is absolute. In any speculative bubble, individuals frantically searching for the new, hyped asset carry the highest risk of total financial ruin. Guaranteed wealth generation during a tech mania comes from monopolizing the picks and shovels that every desperate speculator is eventually forced to buy. Shift that framework to 2026. The modern shovel sellers are companies building the physical, multi-billion-dollar back-end data centers powering the AI ecosystem. Look at NVIDIA. They designed the base hardware everyone needs, operating with massive 53% net profit margins and pulling in nearly $216 billion in annual revenue. This chart breaks down the spending of hyperscalers like Microsoft, Google, Meta, and Amazon. Their combined annual AI capital expenditure will reach $700 billion. Compare that institutional tidal wave against the microscopic $50 million retail puddles chasing meme stock hype. Traditional finance giants are already executing the Pickaxe Strategy. Firms like Blackstone aren't gambling on random AI software startups. They are becoming the largest owners of physical data centers in the world. When the retail AI bubble pops and the meme stocks vanish, the real money will remain securely locked inside the permanent physical infrastructure controlled by these back-end